The word supercycle gets thrown around a lot in commodities markets. It refers to an extended period, typically about a decade or more, of sustained above-trend demand growth for raw materials. And that's driven by a structural economic shift rather than a cyclical upturn. Now, we've seen super cycles before. The industrialization of the United States in the early 20th century and the urbanization of China in the 2000s. The question that professional investors and strategists are debating intensely in 2026 is whether we are in the early stages of a new super cycle, driven this time by the energy transition, the electrification of transportation, and the infrastructure build-out required to support both. The implications for commodity markets, for mining companies, and for traders who can position across these assets through CFDs are enormous. But the supercycle thesis also has credible critics, and understanding both sides is essential before taking positions. Copper has been called the PhD of metals because of its ability to predict economic turning points. It's used in virtually every form of electrification: wiring, motors, transformers, circuit boards, charging infrastructure. An economy that is building and electrifying needs copper, guys. The electrification thesis for copper is pretty straightforward. The International Industry Agency estimates that each electric vehicle contains approximately 80 kilograms of copper. Now compare that to 23 kilograms in a conventional vehicle. Charging stations require additional copper. Grid upgrades to support EV charging, renewable energy generation, and battery storage, that all requires enormous amounts of copper. The supply side of the copper equation is deeply constrained. Major existing copper mines are aging and their ore grades are declining. Discovering, permitting, and developing a new world-class copper deposit takes about 15 to 20 years from discovery to production. The pipeline of new projects is insufficient to meet the demand scenarios projected under the most energy transition models. Goldman Sachs and other major institutions have published research arguing that this demand-supply mismatch is going to drive copper prices significantly higher over the coming decade. The IEA's Global Minerals Outlook supports the view that critical minerals, including copper, face structural supply challenges. Now, for CFD traders, copper is accessible as a commodity, CFD with attractive liquidity and genuine fundamental support. Gold's role in portfolios has been debated for as long as financial markets have existed, guys. Critics argue that it produces no cash flow and its price is driven purely by sentiment. Supporters argue it is the ultimate store of value and portfolio hedge. Now, both are partially right. Gold's performance in 2024 and 2025 has been exceptional. The metal reached all-time highs as central banks globally, particularly in China, India, and other emerging markets, accelerated their purchases of gold as a reserve asset. Central bank demand has been a structural support that differs from the sentiment-driven buying that has historically characterized retail gold investment. The macro case for gold in the current environment rests on several pillars. Real interest rates, while higher than the pandemic era, are likely to decline as central banks ease further. The dollar's long-term trajectory is debated, with significant U.S. fiscal deficits creating pressure on the currency over time. Geopolitical fragmentation is prompting diversification away from dollar-denominated assets. All of these factors support gold. The risk case is that if inflation is genuinely brought under control and real rates remain elevated, the opportunity cost of holding gold rises. Gold pays no coupon. When real returns on safe assets are positive and rising, gold faces competitive pressure from alternatives. Lithium is a critical input for lithium-ion batteries, which power electric vehicles, grid storage systems, and consumer electronics. The lithium market went through a dramatic boom and bust cycle between 2021 and 2024. Prices surged to extraordinary highs as EV demand accelerated and supply was unable to keep pace. Then they collapsed as a new supply from Australia, Chile, and Argentina came online faster than demand grew. This price cycle illustrates a structural feature of mining commodities. The supply response to high price is delayed, but eventually powerful, and often overshoots. The current low lithium price environment has already started to slow new mine development and expansion projects, setting the stage for the next tightening cycle when demand growth reasserts. Other battery metals like cobalt, nickel, and manganese follow similar dynamics. They're geographically concentrated, subject to political risk in their main producing regions, and facing demand growth that is the existing supply base is not positioned to meet over a 10-year horizon. The battery metals complex offers opportunities both in the physical commodity prices, where accessible through CFDs, and in the equities of mining companies that produce these materials. many of which are listed on exchanges where CFDs are available. Intellectual honesty requires engaging with the arguments against the commodity supercycle thesis. There are several credible bearish scenarios. Energy transition timelines may slip. EV adoption has been slower than projected in several markets. Government subsidies that supported demand may be reduced. Consumer behavior may not shift as quickly as models assume. If electrification proceeds more slowly than expected, the demand impulse for battery metals and copper is correspondingly reduced. Technological substitution is another risk. Battery chemistry is evolving. There's sodium-ion batteries, which require no lithium or cobalt, and they're becoming commercially viable in some applications. Efficiency improvements could reduce the metal intensity per unit of energy stored or consumed, reducing demand growth below current projections. Finally, the supply response may surprise. High commodity prices incentivize significant investment in finding and developing new deposits. Deep-sea mining and recycling of battery materials at scale could add meaningful supply that current models underestimate. Now, these scenarios do not invalidate the long-term demand story, but they counsel humility about timing and magnitude. The commodity supercycle thesis, driven by the green transition and the electrification of the global economy, is one of the most compelling long-term investment narratives available to traders today. Copper, gold, lithium, and the broader battery metals complex all offer genuine fundamental support rooted in structural economic change. The discipline is to express these views through instruments with defined risk, size positions appropriately for the genuine uncertainty about timing, and monitor the key indicators: EV adoption rates, mine production data, central bank gold purchases, energy transition policy developments. Which commodity do you think has the most compelling trade in 2026? Please tell us in the comments, guys. We read every single one of them. We'll see you in the next video.